Hello everyone and welcome back to the channel. In today's video we're going to have a look at DHHF, the Betashares Diversified All Growth ETF. We're going to look at the recent changes to this fund, what it invests in, and whether the change from 90% equities to 100% equities really makes a huge difference. In recent years, ETFs have become an increasingly popular way to invest. The ability to buy an entire sector or country stock market in a single product is incredibly convenient. Better still, the possibility of having an all-in-one investment is enticing to many people who want a set and forget option. For years now, Vanguard's VDHG has been the ETF of choice for people seeking that all-in-one option. It is a great product. However, it has one sticking point with many people, and that is the 10% bonds. So in order to fill this demand in the market, Betashares has reworked their DHHF ETF to address this by offering 100% equities and all stock, all round ETF option. So let's take a quick look at some of the changes that have been made as of today. So DHHF began its life in December of 2019 as the Betashares Diversified High Growth ETF. And while it was a very capable ETF, it was essentially identical to Vanguard's VDHG. And because of that reason, it didn't really get a whole lot of traction because people just stuck with what they knew, and VDHG sort of had that first mover advantage. As a result, the assets under management of DHHF stay at about $10 million right now, which is quite low for a fund such as this. But like I said, that's in my opinion due to Vanguard just having such a first mover advantage in this space. As of the 15th of December, yesterday at the time of this recording, this ETF has changed to the Betashares Diversified All Growth ETF, which means it has gone from 90% stocks to 100% stocks. And as a result, its risk return profile has gone from high growth to very high growth. This is for somebody who wants an all-in option, who want to invest over a very long period of time and don't care about volatility at all. There's going to be a lot of people in their 20s and 30s that want something like this. They don't want the possible return drag of having bonds and cash, and they just want to go all in. So the new fund has basically eliminated cash, bonds, and even property securities, and even trimmed the Australian equities down from 40.5% to 37%, and pumped all of the rest into international equities, juicing that up all the way to 63%. And also, another notable point here is the management fee, which has decreased from 0.26% per annum to 0.19% per annum. This is obviously a positive change, but it is worthy of note that there is actually a little bit of a tax drag on this fund because there are US domiciled funds within this ETF that hold non-US assets. So there is a tax drag that I believe adds 0.08 or 0.09% per annum to this fund. So for all intents and purposes, it does kind of increase the management fee somewhat because of that little bit of tax drag. Another point of note is there is no hedged funds in this one, unlike VDHG. So that was one of the complaints of some people with VDHG, is just that quite a bit of it was hedged and it already had a fairly heavy Australian allocation. So this fund amends that particular complaint, and for people that don't want hedged ETFs or hedged funds within their ETF, this is again a sort of ideal choice over the VDHG in that regard. And as for what it invests in, it invests in 4 different ETFs. The Australian component, the Australian equities component of DHHF, is covered by Betashares' own A200 ETF. And this is a fund that tracks the ASX 200 at a very, very low cost. The strategic allocation to international equities is covered by 3 different ETFs. You have VTI, which is the Vanguard's total stock index for the US. Basically, this invests in the US stock market at all levels. You've got large caps, medium caps, and small caps. And then you've got SPDW, which is an investment into developed markets outside of the US. And then you have SPEM, which is an investment into emerging markets. So let's have a quick look and a quick run through of each of these ETFs in a bit more detail. As mentioned earlier, this ETF has a 100% equity allocation, with the breakdown is as follows: 37% to Australian equities and 63% to international equities. This is further broken down in the case of the international equities, with VTI being the Vanguard Total Market Index having 31.5%, the SPDW ETF has 19%, and the SPEM ETF has 12.5% of this allocation. I'm going to quickly run through each of them and just talk a moment or two about what they invest in. I'm not going to go into a massive amount of detail. I'll put a link in the description to each of these if you want to look at them in further detail, but I want to give just a basic gist of what each of these underlying ETFs are about. So at the start, we have the Betashares A200, which is an ASX 200 tracking ETF. It's very low cost. It obviously invests in the top 200 companies of Australia, so very heavy weighting towards the banks. You have CSL up there as well, BHP, very heavily skewed towards financials at the top of the list. It's essentially the same as any other ASX 200 tracking ETF, very low cost, pretty basic. We move on to VTI, which is the Vanguard Total Stock Market ETF for the US. And this is a very vast fund. It invests in over 3,500 stocks in the US market, and it makes up the lion's share of the international holdings. And this ETF, obviously its largest holdings include Apple, Microsoft, Amazon, the big name companies, the big blue chips that you hear about all the time. And not really much needs to be said about this very popular ETF, very diverse, and that's all about I need to say on that. And this next one, the SPDW, is from State Street Global Advisors, and this is a fund that invests in developed nations outside of the US market. So top of the list, you have Japan, followed by United Kingdom, Canada, France, Switzerland, Germany, Australia, South Korea, basically most of the developed nations that are not named the United States of America. And as for the top companies, you have Samsung, Nestle, Roche, Toyota, Louis Vuitton, AstraZeneca, to name a few. So it's a fairly diverse fund. Top holdings are financials and industrials, but neither of them really dominate. And finally, we move on to SPEM, which is again by State Street Global Advisors. And this fund invests in the emerging market, with most notably China being about 35% of this particular ETF's weighting, followed by Taiwan, India, Hong Kong, and Brazil. And this is again a fairly diverse sort of fund. Its top holdings include Alibaba, which is essentially the Chinese analog to sort of Amazon, eBay. You got Tencent Holdings, Taiwan Semiconductor Manufacturing Co., Meituan Class B shares, and the list goes on. So that kind of rounds out the ETF holdings, with the SPEM having around 12.5% of the overall portfolio's weighting. So all in all, with these 4 ETFs added together, you have over 8,000 holdings. So much like the VDHG, you have a massive amount of diversification, and you have no bonds or cash in there. But let's take a quick look at just how much of an effect going from a lower allocation of equities, like 80 or 90% equities plus some bonds, to 100% stocks actually makes. Is it as big an effect as you'd think? You might be surprised, but let's take a quick look. So in moving from a 90% equity allocation to a 100% equity allocation, one has to wonder what sort of a difference this is going to make over the long term. And I want to direct all your attention to an excellent website called Passive Investing Australia, which is really an awesome resource for all this manner of discussion. And on this page, does the 10% bonds in VDHG make it a no-go, actually sort of brings up and fleshes out this discussion in great detail by discussing something called the efficient frontier. And basically that means is when you're on either extreme of the risk to reward spectrum, whether you're 100% bonds or 100% stocks, adding a little bit of the opposite doesn't really alter things all that much. Like adding 10% bonds in VDHG doesn't really drag the returns that much. And basically this is because of rebalancing. People have a tendency to look at the bonds in isolation as a stable, very low growth kind of asset. However, you have to remember they are part of a holistic portfolio that is rebalanced from time to time. And what that means is when the market is low and the stock market's crashing, some of those bonds and cash will be rebalanced into buying more stocks. And on the opposite end of the spectrum is when the market's high, some of those stocks will be sold and basically stored as cash and bonds in a very stable way. So it is reducing your risk, but it's also buying low and selling high for you, essentially, without you really having to think about it. And another page that, and it's actually a link from this passive investing one, is that Vanguard actually have a study on their site showing the difference between a 80% stock and 100% stocks over nearly 100 years. And surprisingly enough, the average annual return is not that much different. Adding 20% bonds to the mix only drags performance by 0.5% over nearly 100 years compared to 100% stocks. So it's definitely something to think about. And really, 100% stocks by all accounts will give you faster growth, but it's not as huge a difference as you would think it would be. It's obviously for people who are trying to min-max and get every percentage point of growth they can, it's going to be significant. And if you're doing it over a long term, it's going to sort of add up, obviously, but it doesn't mean you have to go out and panic sell your VDHG tomorrow if you have it or something like that. But it's something to think about anyway, and to give a little bit of consideration that sometimes having some bonds and cash isn't the end of the world, but obviously there is a very strong case for 100% stocks, and that's the reason why a lot of people have gone, 50% VAS, 50% VGS, and it's just something to have a look at before you sort of blindly jump on the 100% stocks bandwagon, and give it a little bit of thought anyway. And I highly recommend you check out this page and Passive Investing Australia, but I'm going to give my final thoughts now. So in my opinion, Betashares have really upped the ante recently. With the simultaneous release of DHHF, well, the re-release rather, and the Betashares range of ethical diversified ETFs, customers have several options with regards to ETF products. It's going to be interesting to see if Vanguard creates its own 100% stock ETF to counter this one, or whether they're going to alter VDHG itself. I think competition is great for investors, and I personally like watching the ETF providers push one another to provide the most innovative and cost-effective offerings possible. And DHHF is certainly catering to a respectable portion of the passive investing community. I expect a renewed interest in this particular fund, being the only one right now to offer 100% stock allocation. But with all that said though, if you haven't already checked out my videos on VDHG and FD in my ETF profile series, please check them out. If you find this video useful or informative, don't forget to chuck it a like and subscribe if you want to see more content like this. I'm going to do a video very shortly on DZZF, which is the high growth ethical option from Betashares that was released just today. But I'll just say my name is Rich, and I will catch you guys in the next one.